Hey, what's going on, everyone? SteveyTheTrader here. Welcome to episode episode 3, part 2 of market terminology. So, last video I had to cut it short because my laptop was dying, and also it's hard to render videos longer than I think like 15 minutes on my laptop. But yeah, that's just my short explanation. So, yesterday we did part 1, so today's part 2. And I left off on key area, so this gives me a little bit more time to kind of go in detail on these other terms. So let's get right to it. Support and resistance, you'll see just S and R. People are like, what's the S and R? S/R, that's just support and resistance. Pre-market, so this is the time period right before the market opens. So pre-market is essentially this gray area that's not black. So this is what we essentially call pre-market. It's right here. So that's not a good way to divide it. But so anything after it, you'll see like 1 a.m. 1 a.m. pre-market opens, and that's when price is moving right here. So that's why it's grayed out. So we use pre-market a lot for day trading because you want to know what's happening pre-market. There's strategies when, let's say, you break the pre-market low, you'll flush down. That's an idea, but I don't want to dive into that just yet. So, do I have aftermarket on this? Yeah, aftermarket is a time period after market closes. So, what I mean by that is you can trade this time period between market close and market open. So essentially, the full-on market doesn't close till 3 hours after we close, right? So here's 1, and then we end at, I think, 5. I'm in California, so that's my time. So after market, so market closes officially to the public, and then if you have a special brokerage that allows you access to this time period after the market closes, that's what we call aftermarket and pre-market basically. So if you have a special brokerage that allows access to this, then you can trade this time period. It's just low volume, so it's kind of hard to trade. All right, let's go to R&R. So this is your risk to reward ratio. Risk to reward, what does this mean? This means what is your reward? How much can price move in a particular direction in your favor? And risk, this is how much price can move against you. So I actually will do a lesson on risk to reward, but to show you a quick, let's do this. So this could be your risk to reward. Let's move all of these lines out of the way for you guys. Okay, let's do it like this. So you'll see from here, you see the support and resistance levels. All right, you could say that's a $33 range. So a range is when you see a stock move horizontally between a support and resistance. So the range is about 32 bucks, right? So let's say your risk is this, a $30 move. But if you break this support, let's say this line down here, that is a $45 move. It's not the best example, but that's your risk to reward. Your risk is how much the price can move against you, and your reward will be how much can price move in the direction that you want it to go in. You could do like a triangle setup right here. No, a falling wedge. Your risk, you could put it, all right, if we get below here, Yeah, this is a bad drawing, but if we go right here and break below it, that I will sell out and take a loss on the trade. My reward will be at the top of this. So you see how this is maybe a $2 risk. You're risking $2 to make what is that, 49? Let's say $10 roughly. $10 for $2 move against you. So reward 10 bucks in your favor, risk $2 against you. I'll go in depth on another video, but let's move to PCO. Previous close, where price closed at the closing time. That can be in regards to the time frame you're on. So the previous close of this candlestick would have been, remember, red is top down. So 842.91. That is the previous close before this candle. And then you could say, if we break above this previous close, I will get in the trade to the long side. Okay. You can also do this previous close of when the market closes. So the previous close would have been right here, 839, and you're like, I will get into the trade long, the bullish mentality if we get above 839. Okay, so that's just previous close in regards to either a candlestick or the day's previous close, one of those two. All-time highs, this is the highest price it's ever been in its history. So we could do Microsoft. You go on, you usually will go on the max chart. Actually, I only have the monthly. But yeah, this is all-time high, 349.67. That's the highest price has ever been in its entire history being in the market. Okay. Let's put this back just in case we need it. We're right here. FOMO, fear of missing out. So if I have FOMO, I have a fear of missing out. You see a stock aggressively moving in one direction. You believe if you don't get in now, you'll miss out on profits. So, oops, that's on me. Sorry. It's hard to navigate all these windows. Fear of missing out. So you could just say right here, you see price was going down, and you're like seeing it, oh my, it's gonna keep tanking, it's gonna keep going. Wow, I don't want to miss out on the profits. Like, I need to get in. And then let's say you get in here, and the next thing you know, price is reversing against you. And almost always when you have FOMO, the price is gonna reverse right there, because you think about it from a psychology standpoint. If you see this aggressive move, everybody else is seeing it, right? So collectively, everybody's gonna be wanting to get in the trade the more it's going up or down. And then the institutions, the people that control the market, they are going to just like literally just reverse. The price is gonna reverse right there, and then you're gonna lose on your trade. So that's why it's never good to have FOMO. We all have it though, and it's something you just have to fight in your head every time. So let's move stop loss. This is a predetermined price level where you will get out of on a lot. You will where you will get out and take a loss on the trade. So stop loss, you put a stop loss in. So you're gonna say, all right, stop loss. You could put right here, and then right here. Stop loss. So let's say when price bounces right here and breaks above this support. I don't know why I can't talk this morning. So price breaks above here. You're gonna use your R&R, your risk to reward. You're like, all right, price can get back to here. So that is a $4 move for a $1.50 risk. So stop loss. That's what my brain is not working. I haven't had coffee this morning. Okay, so stop loss. You're gonna say if price gets anywhere below this area right here, it will stop your losses. So you say I will get out here of the trade. I'll take a loss. So that's what a stop loss is. You can have actual stop losses. So if you execute the trade when you're making an order, you could put stop loss orders, so it will take you out of the trade at that certain level where you want to take the loss. Or most people, once you're really good trained, you have a psychological stop loss. So basically, you're putting a price area on the chart where you're gonna get out. So if once it bounces, well, it gets right here, you're gonna go in, make a trade, and execute for the loss. It's just hard to do that because that's where these voices come in your head and psychologically they're like, yeah, maybe give it another 20 cents and then price goes down again and you're like, yeah, maybe give it another 30 and it just spirals out of control. Target. This is a predetermined level where you will close your trade and take profits. So same example. Stop loss is this area. Your target is right here. This is where you're going to take profits on the trade. All right. We're going to do consolidation where price isn't making much movement and has based out. Buyers and sellers are in agreement. So consolidation. You can say this is consolidation right here. So you see how price isn't really moving up or down, it's kind of just basing out, staying like this. This is consolidation. And it's very good to see consolidation because if you have an aggressive sell-off like right here or a move up, you want to see it base out because then it can make the next move in whatever direction. So I want to see if I can find a bigger time frame example. Right here. So you see how we had a move down, we bounced between these levels, and then we made the aggressive move down. Okay, that's consolidation. Pretty easy to visualize. Same thing, consolidating. It could be consolidating slowly upwards. You see right here, we are consolidating in this direction. We're bound. It's basically a range. And then look, once we broke out of it, we flushed down. Okay. Back holder holding on to your trade way past your stop loss. Prices are going against you and you refuse to get out. So that was the same thing as what I was talking about earlier, where you wanted to get out right here at the stop loss, but you didn't want to, so you're just holding the trade. And this is a bad example, but usually it'll go against you, and then it just keeps going and going. Let's go to Tesla. Show you guys a better example. So let's say here, you wanted to get in the trade once we broke above, let's say this, okay? And then you thought price was gonna go up above this and just keep continuing up, okay? So you can say, oh, my stop loss would have been right under here at the low of this wick, this candle, but I wanted to get above here. So let's kind of do this for visual purposes. Edit, make it red. Okay, you wanted to get above here, go long, but you got faked out. Here's your stop loss, the red line, but then price breaks right here. And then you just keep holding the trade, and then you're next thing you know, you're down 100, down 200, down 300, down 400, down 600. Next thing you know, look, price went all the way down, and you just blew up your whole account. So that is a bag holder. You're holding the bag. Stop holding the bag. Okay? Oops. Paper hands, you got scared out of a trade because it started going against you even though it didn't hit your stop loss. So paper hands, you paper handing, let's say right here, we wanted to get in the trade below this line here, and with this candle, once this trade went right here, you got out of the trade, but your stop loss was right here. Let's say it was right here. Let's reverse this. Okay, make it green for visual purposes. You wanted to get out right here, take a loss, and then you wanted to get in the trade right here, and then take profits here. So let's say you got in here, and then the price went up right here, and you got scared because you were down like 50 bucks. You're like, no, I don't want to lose it. So you sell your trade, and then look, if you just followed your plan, you would have made a bunch of money. So that is paper hands. You don't want a paper hands. So next term, I know I don't need to show you because I know what it is. It should be diamond hands, but I'll just double check. Diamond hands. Diamond hands is basically the reversal of that. You diamond handed, so even though there was this not nasty wick against you, you didn't get out the trade because you knew this is your stop loss and this is where your target is. So you held, you diamond handed it. Sometimes diamond handing is you could be like, let's say right here, and you're underneath your stop loss, but you're seeing the rejection, so you're not gonna get out yet because it might reverse and then boom. Okay, so just the reverse of that. Security, this is a financial asset. I just threw that in there. Market cap is share price times outstanding shares. So people will say, is it a large cap stock or is it a small cap stock? That just refers to, Apple's a very huge company. It's not. I don't think it's gonna show here, but usually you'll see a market cap of like 3 billion. So remember, it's shares times share price. But compared to, let's say, I kind of have well-known companies here, but we can go with UAL. This is United Airlines. You see how price is pretty low, $36 compared to Apple. So Apple was going to have a larger market cap because it's higher share price times the price times the amount of shares. So you have this 36 bucks times the same amount of shares, and it's going to be smaller. Small caps are just, they basically have less shares for a smaller price. It's just good terminology to have. Why do I keep doing this? Okay, we're almost done. So due diligence, you spend your own time creating R&R, risk to reward for a trade, and you create support and resistance, overall making your own analysis of the plan. So that just means you are in here creating a plan, okay, of the trade. I'm gonna get in right here. I'm gonna take shorts for a target here and a stop loss here. You're making a plan because if you don't do your own due diligence, somebody could come in and be like, hey, if we break 43.32, I think we can take it long and we can make $300 on the trade all the way up here to this blue line. All right. They tell you to do your due diligence because this person could be saying all this mumbo jumbo baloney that isn't true, and you are gonna get wrecked on your trade if you don't have a plan. Never go in a trade without a plan. That is the most important thing when trading. So that's why they say do your own due diligence, create your own plan, kind of see like, all right, I can see why the trade's gonna go this way. And I keep doing it. I'll get better at this. Okay, cover. So when traders are short, they need to buy back their position shares to close out their position. Okay, so that goes back to being short. Ooh, my bad. I didn't mean to pull up this one. So if you're short, like I said, you sell the shares, you borrow them, and then you buy them back at a price. So shorts need to cover their position, so they buy them back to give them back, and then they keep the profits. So I shorted the stock at 42.30, and I covered at 40.50. That's how a sentence would go like that. So basically you're meaning I took the position at 42.30 and I got out of my position at 40.50. Simple terms. Okay. If you guys need help, just Google buying power. So this is how much money available to trade. That's pretty self-explanatory. So my buying power is $1,000. My buying power is $300, right? A whale. This is a person or an organization, firm, brokerage that has massive buying power and moves enormous positions in the market, millions. So a whale, think of a whale. It's big, it's huge, right? So if you see a whale, it could be like somebody moving millions of dollars, and you know when a whale is there because these aggressive moves, right? You'll see it, and when I teach you guys level 2, yeah, see how the bid and ask, there's 16. This is in regards to how many how many shares are being bought or sold. So a whale, you'll see like this, 44. That's 44 times. That's 4,000. So you can see 120. That's 120,000 shares somebody's trying to unload on you. Okay, so those are whales. Market makers. I kind of have this definition botched, so kind of just ignore it. I would recommend just Googling it and looking it up because I couldn't really make my own definition. I just wrote individual participant or firm that makes trades on its own. They provide liquidity to the market. So moving to next, liquidity. This is availability of assets in a market. So liquidity, how many shares there are in a market. So if it's high liquid, there's like 2 million shares. Okay, like you see here, liquid. Liquid is in regards to the shares, 65,000. If there's only 100 shares, this price is not going to move like this. Okay, you're not going to be able to get in and out of trades pretty easily. So you want liquid markets, meaning high volume, over 65,000, like 100,000, 75,000. That's liquid. That's a lot of shares that are available in this market. Okay, so you want high liquid markets. You don't want low liquid because if there's only like 300 shares, you guys, this price is not going to move at all. You won't see it. Volatility, price fluctuations in the market. So this is in regards to how aggressive the market moves. So let's go to SPY. These last couple days have been very volatile. So that just means like how you'll see these big aggressive bounces up and down, up and down. I don't think it's loading here. Yeah, it's taking a while. Yeah, you can see it's just right here in this bottom corner. You see how we're just aggressively bouncing up and down like crazy? You see these aggressive down move, then up, then down, and the same thing, down, up, down, up. And when we're in a low volatile market, I don't think I can really show you guys an example. Walmart. When you're in low volatile, it'll do these steady moves. Like you'll see like a little move up and then down, and then a little bit move up and then down, or you might see it bounce like this, just in between. Walmart had some nice moves. I actually saw this trade the other day. I'm mad I didn't take it, but oh well. So that's what volatility is. It's just you'll see boom, you'll just see yeah, boom, and then boom, and then you'll see a nastier move up, and then you'll see this, and then, yeah, it's all a mess, okay? That's volatility. Options offers the buyers the opportunity to buy or sell depending on the type of contract they hold, the underlying asset at a strike price. That is a very bad definition that I wrote, but options are basically when I go here, move, like I've said it in my other videos, I'm an options trader. They're basically these things right here. So these are the contracts that you buy. So each of these is in regards to, you times them by 100. They're equal to 100 shares of Snapchat, $33. So it gives you, it's kind of hard to explain. You need to watch like really in-depth videos for you to get a good explanation, but these are just contracts, and then you multiply them by 100. So 278 by 100, it's $278. That's how much this contract is. It's $95, $100, $86, $90. You multiply it by 100, and that's how much the contract costs, and we buy and sell them for profits and losses for trading. You can use them for shares, but that's kind of a lot to explain. I don't. This is mainly a terminology video. Okay, puts, calls. So this is in regards to the options. So option contract that goes up in value when the stock goes down. That's puts, calls, option contracts that go in value when the stock goes up. So that same thing. So these are calls. These are call contracts. So these contracts, they go up in value when price goes up. And then puts, just remember calls, price goes up, puts, price goes down. That's all you have to remember. These are the put contracts, and then they go up in value when price goes lower. Simple. Okay. And yeah, that's all I have written down for you guys. Very long 2-piece video. I hope I kind of hit the nail on everything, but I know I didn't cover everything that there is. There's other terms, they'll come up, but I'll explain them if you guys ever have questions. But yeah, if you guys do have questions, just email me, comment, hit me up on my social media. The links are down below of the social media I use. I'm more so on Twitter, but I'll get back to it on anything. There's also a podcast out. I haven't made an announcement on that, but yeah, there's a podcast. I'll probably link it in this episode. I might make a better announcement on the other video. Anyways, I'm just rambling because this is very long recording time. But hope you guys enjoyed that. I broke down everything and I kind of helped you guys to get a little bit of an understanding in market terminology. Hope you guys enjoy the rest of your day, and I'll see you guys on the next video. Thank you.